Imagine building a portfolio that sends you a paycheck every 3 months, without you having to lift a finger. That's the beauty of quarterly dividends. Today, we're looking at 10 of the best blue-chip stocks in the S&P 500 with a rock-solid history of paying, and often increasing, their dividends. Today, we're diving into 10 of the best blue-chip stocks in the S&P 500 that pay quarterly dividends and have the track record to prove they're worth holding. Let's get started. Before we dive in, make sure to hit that like button and subscribe. You don't want to miss out. I post weekly breakdowns to help you grow your wealth, and trust me, your future self will thank you. We're starting with a true legend, a company that defines long-term reliability, Dover Corporation. It has been paying and increasing its dividend for an incredible 70 years. To put that in perspective, this company has not only survived but thrived through the Cold War, the oil crisis of the 70s, the dot-com bubble, the 2008 financial crisis, and the recent pandemic, raising its payout to shareholders every single year. This makes it a Dividend King many times over, a title reserved for companies with over 50 years of consecutive dividend growth. Dover's resilience is a testament to its powerful yet often invisible business model. They're an industrial powerhouse making essential equipment that powers the global economy. They operate across key segments like clean energy and fueling, imaging and identification, and pumps and process solutions. This isn't a company that relies on a single product or industry. When one sector is down, another is often up, creating a balanced and incredibly consistent cash flow. Their growth is fueled by a smart strategy of acquiring niche, market-leading companies, which they then integrate into their global network. For income investors seeking a bedrock of stability, Dover is a foundational holding that works tirelessly behind the scenes. Next, we have a company you almost certainly interact with daily, probably before you've even had your morning coffee. If you've ever brushed your teeth with Crest, washed clothes with Tide, or used a Gillette razor, you've contributed to Procter & Gamble's legendary dividend. With 69 straight years of increases, P&G is the undisputed king of consumer staples. These aren't luxury items people cut back on during tough times, they're everyday necessities. This is the definition of a defensive stock, providing goods that people buy out of habit and need, regardless of whether the stock market is soaring or plummeting. This isn't just an American story. P&G's brands are household names in over 180 countries, creating a vast and predictable revenue stream. But they don't just rest on their laurels. A significant portion of their revenue is reinvested into research and development, leading to constant innovation that keeps their brands at the top of the market. This powerful combination of brand loyalty, global scale, and relentless innovation makes the investment thesis simple and powerful. For investors, P&G is the ultimate sleep-well-at-night stock, providing reliable dividends that have weathered nearly 7 decades of economic storms. Our third stock, Johnson & Johnson, recently made headlines for a massive strategic shift, but its dividend story remains as compelling as ever. The company has continued its streak of over 60 years of dividend increases, proving its unwavering commitment to shareholders. This strategic move was designed to unlock greater value by creating 2 more focused, agile companies. The consumer brands like Band-Aid and Tylenol, now live under a new company called Kenvue. The remaining Johnson & Johnson is now a pure-play healthcare titan, focused on 2 high-growth sectors, pharmaceuticals and medical devices. In medtech, they are leaders in surgery, orthopedics, and vision. In pharmaceuticals, their pipeline is packed with potential blockbusters in areas like oncology and immunology. This business is protected by a formidable competitive moat, built from thousands of patents, deep regulatory expertise, and a research budget that rivals that of many small countries. This creates a diversified revenue stream that isn't dependent on a single blockbuster drug. Crucially for income investors, the company structured the split to ensure the combined dividend from Jan-DJ and the new Kenvue stock would continue the growth trajectory, keeping its dividend payouts exceptionally safe and making it a forward-looking bet on the future of healthcare innovation. While Coca-Cola is a pure-play beverage giant, its legendary rival PepsiCo has been quietly rewarding investors for decades with a different strategy: diversification. PepsiCo's genius lies in its dual-pronged attack on the consumer market. Its Frito-Lay North America division is a juggernaut, controlling a massive share of the salty snack market. This isn't just about soda, it's about dominating the entire snack aisle alongside owning household names like Quaker Oats and Gatorade. This strategic diversification creates a powerful hedge. When beverage sales face headwinds from health-conscious trends, the snack division often picks up the slack, ensuring a stable and predictable revenue stream. This financial resilience is the bedrock of its dividend policy. Their products are on shelves in over 200 countries, and that incredible global reach has fueled consistent growth and quarterly dividends for over half a century. For an investor, this isn't just trivia, it's a testament to a business model that has weathered recessions, market crashes, and shifting consumer preferences. Achieving the prestigious title of Dividend King signals a deep-rooted commitment to shareholder returns, making it a cornerstone for many income-focused portfolios. Golden arches, golden dividends. Many people think McDonald's is in the burger business, but savvy investors know its true power lies in real estate. The company strategically owns the land and buildings for a vast majority of its locations worldwide. Franchisees don't just pay for branding and supplies, they pay stable, high-margin rent to corporate headquarters. This model, often called the landlord model, is brilliant. It insulates the parent company from the day-to-day volatility of food costs and labor shortages that affect individual restaurants. While a franchisee worries about the price of beef, headquarters cashes a steady rent check. This creates an incredibly predictable river of cash flow, insulating it from the typical risks of the food industry. It's this river of cash that has allowed McDonald's to raise its dividend for over 45 consecutive years, placing it firmly in the elite Dividend Aristocrats club. For investors, this means owning a slice of one of the world's most valuable real estate portfolios, which happens to sell burgers and fries on the side. It's a masterclass in building a durable, income-generating machine. We all know the iconic brown truck, but United Parcel Service is far more than a delivery service. It's a titan of global logistics with one of the widest competitive moats in the market. Think about what it would take to replicate its network: a global fleet of over 500 aircraft, more than 100,000 vehicles, and thousands of technologically advanced sorting hubs. The sheer capital and decades of operational expertise required to build this infrastructure make it nearly impossible for a new competitor to challenge them at scale. This makes UPS a classic picks and shovels investment for the e-commerce gold rush. You don't need to bet on which online retailer will win. You can invest in the company that provides the essential service of delivery for all of them. Its network is the circulatory system of modern commerce, forming the backbone of the digital economy. This indispensable role translates directly into pricing power and robust cash flow. While the company is cyclical and tied to economic health, its long-term trajectory is firmly linked to the unstoppable growth of online shopping. Management has shown a strong commitment to rewarding shareholders, often with significant dividend hikes, making UPS a compelling way to invest in the future of commerce while collecting a dependable payout. Kicking off our final set is a name that became a household staple during the pandemic: Pfizer. But their story, and more importantly for us their dividend history, began long before that. Founded way back in 1849, Pfizer has a legacy of blockbuster drugs like Lipitor and Viagra that have shaped modern medicine. Their commitment to shareholders is just as impressive, having paid a dividend for over 300 consecutive quarters. Now you might see its recent high yield, which has hovered around 7%, and wonder if it's too good to be true. This is a direct result of the stock price pulling back from its pandemic-era highs. For investors, this presents a potential opportunity. That attractive yield is supported by decades of drug innovation and a robust pipeline of new treatments in areas like oncology and rare diseases, signaling a long-term strategy that continues to reward its investors. Next up is Bristol-Myers Squibb, or BMY, another pharmaceutical powerhouse yielding about 5.4%. BMY shines by specializing in complex high-margin treatments for challenging diseases in oncology and immunology, with major drugs like the blood thinner Eliquis and cancer therapy Opdivo leading the charge. But what truly makes BMI compelling for an income investor is its financial discipline, specifically its strong earnings coverage. Let's break that down. This is measured by the payout ratio, which tells you what percentage of a company's profits are paid out as dividends. BMY maintains a healthy ratio, meaning its profits comfortably cover its dividend payments with plenty left over to reinvest in research and development. This isn't just a number, it's a signal of financial health and sustainability, a critical green flag for anyone building a long-term income portfolio. If you crave stability, our ninth stock, Edison International, is a classic choice that delivers, literally. As a utility, they operate in a highly regulated environment, providing an essential service, powering millions of homes and businesses in Southern California. This creates a predictable, reliable revenue stream that's the bedrock of their attractive 6% yield. With roots tracing back to Thomas Edison himself, the company isn't stuck in the past. They are actively future-proofing their business by investing heavily in grid modernization and clean energy. This includes massive projects in wind, solar, and battery storage to meet California's ambitious renewable energy goals. This dual focus on present stability and future growth makes EIX a powerful component for a balanced dividend portfolio, though investors should always be mindful of risks like regulatory changes or the impact of natural disasters. And finally, our 10th stock is a Dividend King you might not know, Parker-Hannifin. To earn the prestigious King title, a company must increase its dividend for over 50 consecutive years. Parker-Hannifin has done it for an incredible 67 years. So what do? They are a global leader in motion and control technologies. That sounds complex, but their products are everywhere, often hidden in plain sight. Think of the critical hydraulic systems that move an airplane's wings, the pneumatic actuators in factory automation, or the filtration systems in heavy machinery. Because their technology is essential across countless industries, from aerospace to manufacturing to life sciences, they aren't dependent on any single sector's fortune. This diversification, combined with a consistently low payout ratio, means their dividend isn't just safe, it's primed for continued growth for years to come. And there you have it. 10 reliable, quarterly paying dividend stocks that offer a variety of strategies for your portfolio. We've covered a lot of ground, from high-yield opportunities in the pharmaceutical sector to the bedrock stability of utilities and the incredible long-term growth of a Dividend King. It's crucial to understand that there isn't one best type of dividend stock. Some, like Pfizer, might appeal to those seeking higher immediate income. Others, like Parker-Hannifin, are for investors playing the long game, prioritizing steady, reliable dividend growth over a high starting yield. The ultimate key to success is diversification. By blending these different approaches, you avoid the trap of chasing the highest yield, and instead build a resilient portfolio that can weather market volatility. This balanced approach allows you to harness one of the most powerful forces in finance, compounding. When you receive a dividend, you can use it to buy more shares through a dividend reinvestment plan, or DRIP. Let's imagine you own 100 shares of a stock that pays you $100 in dividends. Instead of taking the cash, you reinvest it to buy, say, 5 more shares. The next time dividends are paid, you'll earn them on 105 shares. It might seem small at first, but over years and decades, this process creates a snowball effect, dramatically accelerating your portfolio's growth and building a powerful passive income stream for your future. Remember, this video is for educational purposes and is not financial advice. Always do your own thorough research before making any investment decisions. If this deep dive gave you some valuable ideas, show your support by hitting that like button and subscribing for more content just like this. Now, I really want to hear from you. Which of these strategies, high yield, dividend growth, or stability, fits your personal investment style the best? Drop a comment below and let me know which stocks you're watching. I read every single one and might even feature your suggestions in a future video.